Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. Hey, welcome back. It's been a while.
Yep.
We missed a quarter, and so we kind of feel like maybe all this is our fault a little bit because we didn't give you an update in Q4 of 2024. So we're back giving you an update with Ticker Talk at the end of the first quarter of 2025. So we're going to dive right into it. We're recording here on April 19th, and so it's kind of apt that we waited until a little bit after the quarter because it's been an action-packed April so far. So we're going to go ahead and jump right into it. Talk markets, talk investing, talk tariffs, a little bit of everything. So let's get right into it.
Okay, let's go. Well, the general market had a down first quarter for the first time in 2 years. So we talked at the end of 2024 about the fact that markets were up 20% in 2023. Markets were up over 20% in 2024. I mean, that was the first time that had happened since 1997, 1998. Yeah. So those occurrences don't happen very often. And what goes up inevitably must come down. So we call that regression to the mean. And the S&P 500 was down 4.3% through the first quarter of 2025. And the NASDAQ was down 10.8%. So you see that emphasis on more technology, more Mag 7 impact on that particular index. A little bit of a reprieve was the Dow. It's not my favorite index, but as a measure of sort of financial stocks, value stocks, it was only down 1.5%. And so that buffered you a little bit from that sort of Mag 7 quote tech wreck, if you want to call it that. We're not quite there yet, but
no,
it was a correction for the first time in a long time.
Yeah, and so a correction, just to be clear, is a 10% decline in the market. So you see that in the NASDAQ, and as we sat at the end of the quarter, March 31st, it was we were treading water a little bit. Tech stocks were down, but the Dow was really positive for a lot of the quarter and then ended the quarter kind of on a weaker note.
Well, that's an interesting, let's just back up. A lot of the headlines that we have felt over the last 2 or 3 weeks have had an impact, but we started the quarter on fire.
Yeah.
Because you had this, inauguration of a quote, business friendly administration.
Yeah.
And that was sort of what was driving. And there was this just massive buildup into what is a current market high, February 19th of 2025. And it's so ironic. Did you know that is 5 years ago, February of 2020, right before COVID, was also the market high for the S&P.
Sure.
And then we fell off a cliff in March as the world closed down. So, history doesn't repeat itself, but it sometimes rhymes. So here we go into February, mid-February, reaching all-time highs on multiple indexes, and then everything changed.
Yeah. And
very rapidly.
So we talked about in our last episode that we recorded of Ticker Talk, it almost started to get monotonous because it was like, we're sitting here and the market's up again. But we emphasized in our last recording, hey, you've got to enjoy this while you're sitting there and while it's happening.
I would tell people to frame their statement. I was like, you should frame that.
Yeah, you should frame your statement. That's good. And so that's why. I mean, it seems silly, and when it's going up like that and everything feels good and the headlines are good, it feels like, man, I mean, maybe we won't have a down year. Maybe we'll just be flat. And again, this is the first quarter, so we don't know what the year is going to look like as a whole. But it has been a volatile last couple weeks, and that is why you have to enjoy the market highs when you're at them.
When you get them.
Because they don't come as often as you think they do.
Right. And so, here we are.
Yeah.
And so, what are the key events? What has happened in this sort of? We're going to blend a little bit.
Yeah.
This sort of first quarter and the first couple of weeks in April.
Yeah.
For the simple fact that if we don't talk about the first couple of weeks of April and we wait until July to talk about it, it'll be ancient history.
Yeah.
So, what happened, Louis?
Yeah, so we have been moving at 100 miles an hour since the start of April, since April 2nd. So the quarter ended, and like we said, it ended a little bit down, but there was no major headlines besides just tech sell-off, essentially. And then on April 2nd, the president announced tariffs. Liberation Day. The president announced tariffs on 70 plus countries across the world, and big tariffs on China, which is where a lot of consumer goods come from across the country and across the world. And basically since then, the market went down.
Yeah.
Every sector. I mean, there was days where I was looking at my screen full of tickers and everything was red. There wasn't a green thing on the screen.
Right.
And so, I mean, and it was in increments of 2.5%, 4%, 5%. And it was a total gut punch after 2 years of 20+% returns.
Yeah.
And so we kind of went on that downward spiral for a week and a half. Mm-hmm. And then last Wednesday, April 9th, we were set to open in bear market territory.
Which means down 20% from your recent high.
Yeah, and which means that 20% of your money is gone.
Right.
Like we like to kind of
your equity money.
Speak in euphemisms a little bit. Oh, it's a correction. Oh, it's a bear market. It sounds, kind of nice. Oh, what's that mean? No, 20% down from the high. That's tough. And so the market opened on April 9th, and we were in bear market territory for the S&P 500. And then
the pause.
There was a pause announced.
You had to be cool.
You had to be cool. And so the president announced a 90-day pause on the tariffs that were announced a week and a half before. And I told you this story. I was in the TSA line at the airport coming back from a Baird conference, and I put my phone and my bag in the bin to go through TSA. We were marginally up, about 0.2%, I think. Mm-hmm. By the time I got through security, we were up 8%.
Up 8%. So that is, on the NASDAQ, that was 1,600 points. That is unheard of, and I've never seen it.
It was one of the biggest positive moves in market history.
Yeah, history.
And that's not hyperbole.
Right.
That is a factual statement. So pretty crazy. That's kind of what has happened and why we're talking about, the first couple weeks of the second quarter, because we have to, because it's history.
Yeah, and so a lot of this has led to an investor sentiment that is all of a sudden gone from euphoric to cautious. Now, I will say I'm kind of okay with that in a way, meaning I'm not okay with your account being down during these tumultuous periods, but I am okay with taking sort of the euphoria down.
Yeah.
When euphoria hits, a lot of traders will go on margin. That is to say, they will leverage their existing portfolio, borrow money to buy more stocks. And at that point, it becomes a momentum trade. They're just buying more because it's going up.
Yeah.
And they're doing it on borrowed money. So when the balloon gets deflated, we always say stocks go from weak hands to strong hands. Mm-hmm. And so those that have borrowed money to do that are the first ones to sell. They get margin calls, they get scared,
Yeah.
and they pull out. Long-term investors, people who have not borrowed money to own stocks,
Yeah.
tend to be long-term holders. And so prices adjust back to a level that sane people, will hold them.
Yeah.
And they become opportunities.
Yeah.
And so that investor sentiment has dramatically changed in the last 3-4 weeks with all of the tariff talk. But it is, I will say this, it is also backed up a little bit by a cooling of corporate profit estimates. So we are seeing a consensus estimate for all of the S&P 500 companies to report year-over-year earnings growth of plus 11.5%.
Yeah.
But that's down from 14.
Yeah.
So we thought they were going to grow 14% year over year, and now it looks like they're going to cool to only in air quotes,
Yeah.
up 11%. That is still really good.
Yeah.
But the market trades on sentiment. So those are some of the things that we're seeing out here in the marketplace.
So, in terms of sentiment, you talk about kind of tampering expectations on the S&P earnings side of things, but the S&P is United States companies,
Right.
and so there's a guy by the name of Jim Cramer, and he's got a quote that says, "There's a bull market somewhere." And
I forgot.
it kind of makes me laugh, but it's true,
Right.
to an extent. And the bull market this year has been overseas. It's been international.
Yes.
So you want to touch on that a little bit?
So the question becomes, in the middle of all of these things, so you've got tariff talk, you've got lowering expectation of corporate profits in the United States, you've got the perhaps rising of prices, right? So tariffs in effect raise the component prices of everything because they're being shipped in and put together and assembled here. And so your iPhone, which was costing you say $1,100, if AT&T or Apple or Verizon doesn't subsidize that component price, all of a sudden your new iPhone is going to cost you $1,500. That's inflationary.
Yeah.
So that has the effect of the Federal Reserve having to keep rates at a higher level to combat those type of prices.
Yeah.
So without getting too deep into the weeds on that, what works in that situation? Well, our old friend diversification.
Yeah.
So we've been concentrated in the S&P 500. We've been enamored with the Mag 7, whatever 7 of those you like.
Yeah.
And out of nowhere, this contrary investing of international value dividends make sense. So you might touch on that sort of value and growth divide.
It's so hard, right? Because for especially the last 10 years, you have gotten crushed if you tried to not own tech.
Right.
Big tech, big U.S. tech. That is where
American exceptionalism.
Yes, 100%. And that's where the biggest market gains were. So whether you were an advisor, a portfolio manager, an individual investor, in your 401k, wherever it was, you had to own big tech to an extent to get the gains of the quote market. And to that end, if you owned international instead, or if you owned
as a sleeve
of your portfolio, it would be a laggard on your portfolio and it would bring your returns down.
Right, your total return.
And so it's kind of been just kicked to the wayside. And for good reason, it hasn't performed as well. But here we are, and when you're sitting there asking yourself for years, why do I own this? What is the point? Why do I own in international stocks? Or any really sort of diversification, because the market's gotten so concentrated that diversification seemed silly.
Right.
And so this is why.
This is why.
Because when you are entering correction and bear market territory, there's a bull market somewhere. And when you diversify, you tamper your returns and your downside you limit your
And
downside.
to use a sports analogy,
Yeah.
right? Who doesn't love offense, right? I love scoring goals. I love scoring touchdowns.
Yeah.
Anytime I can put points on the board, shoot the ball through the hoop, name your sport. Offense is great.
Yeah.
What wins championships?
Defense.
Defense wins championships.
Defense wins
and
championships.
You've got to have defense, and diversification is a little bit of that.
Yeah.
And so, what you have to do as an investor is think through, okay, last year S&P 500 is up 25%. My portfolio was only up 16%. Like, what happened? Oh, well, here's what happened. You had 20% in treasuries. You had 10% in international. You had small caps, mid caps, large caps. So you participated, and your sleeve of the portfolio that was in large caps might have been up 20, 25%.
Yeah.
But these other things held you back. Well, guess what? This year, that's saving your bacon.
It's
So
absolutely.
I often laugh with the crew here, and I say, sometimes we want to be on the beastie roller coaster
yeah.
and not the beast roller coaster.
Yeah, absolutely. I mean, you sometimes, so you look at the end of the quarter, and like we said, it is the beast roller coaster is growth. The beastie is value. And if you look at where the quarter ended, value stocks ended the quarter up over 4%. Growth stocks down almost 10%.
Right.
And that's the story. That's it right there.
So on $1 million, just to make math really simple, on $1 million, if you're in growth, you're down 92,000. If you're in value, you're up 44,000.
Yeah.
So our friends at Strategas, who is our macro and economic strategy company, says choose your adventure.
Choose your adventure.
So, we're looking ahead. We're looking ahead to what's going on in the second quarter of 2025. And, we have seen a pause in these tariffs.
Yep.
That has calmed the waters
Yep.
of the overall markets. And now it's time for earnings. So we are actually in the middle of earnings season. The big tech companies report this coming week.
Yeah.
So we will know more. We'll know a little bit more on how all of these policies are going to affect those earnings. But remember, earnings are always looking back. So this is pre-tariff earnings.
Yeah.
So we'll get guidance on what they think. And we'll get guidance from the administration on how their individual country negotiations are going.
Right.
And the hope is that there are some deals made with our major trading partners such that we come to a détente on this, and everybody can sort of go back to, earnings, making great
Products, providing great services. Ultimately, no matter what the markets are, no matter what the headlines are, no matter who's president, no matter what is happening, earnings matter. Earnings drive the direction of markets over time.
Yep.
In the short term, it's emotion.
Mm-hmm.
In the long term, it's math.
Yep. Voting versus weighing, like our good friend Buffett always says. So to recap a little bit, we basically had the first quarter that was
Roller coaster.
a nervous kind of anticipation of tariffs. 2 days into the second quarter, we got the tariffs.
Right.
And then we got on the beast.
And 7 days later, we got rid of it.
And we went up
the
and down. And so then 7 days later, we paused them. And it was a 90-day pause, which for those counting, 90 days is a quarter. And so when we get back, we're going to have a few answers because the uncertainty at the beginning of the quarter was, hey, what are these tariffs going to be? We got that answer. And then it was, hey, are these tariffs a negotiating tactic or is this where we are?
Right.
Turns out they were a negotiating tactic. So now we get to see if we can negotiate. And then, like you said, we have earnings to give us a little bit of clarity as well on a company by company basis, but a policy and economic macro basis. We'll get answers as we go, and we'll have plenty to talk about next time, I'm sure.
Plenty to talk about for sure. So just remember, think long term. Remember that if you're feeling like this has never happened before, it has happened. Mathematically, here's what I say. Mathematically, this happens over and over.
Yeah.
But the headline is always different. So
Yep.
just know that we've been here before, know that we'll be here again, and adjust your thinking to how you deal with this.
Absolutely. All right. We'll see you next quarter.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell or solicitation of an offer to buy or sell any security or investment or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird & Company Incorporated. Please note past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird & Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.